Welcome back to the watch list. Time now to recap some fast food earnings and fast casual after McDonald's reported a 3.6% drop in U.S. same-store sales, its biggest drop since the early days of COVID. I want to bring in our panel this afternoon. We've got James Demmert, founder and chief investment officer of Main Street Research, and Dan Ahrens, managing director and portfolio manager advisor shares. It's good to be with both of you today. All right, James, I want to start out with your thoughts on McDonald's. They reported slightly better than expected adjusted EPS, but revenue came in weaker than expected at below $6 billion, and this miss on same-store sales. What does it say to you about McDonald's and the state of the consumer?
Well, I think the miss at McDonald's is similar to that you've seen in other restaurants last quarter. And I don't want to say blame it on the weather, but I'm going to say that. I mean, weather was horrible all around the globe. If you were in New York, I was. A lot of people didn't go out. And I think that's the real problem. Chipotle had the same problem with their numbers. So I would suggest that investors don't overemphasize the same store sales being weak here. And maybe look a little bit forward out the next few quarters. This is a very consistent growth company that's got the right mix of U.S. and overseas exposure. So we're a buyer of the stock, we own the stock, and we like it here.
Okay. Dan, I'm curious to know your thoughts on McDonald's, especially how it performed. And it's not just about weather. We are starting to see signs of a weakening consumer. What are your views?
Yeah, I have a little bit different take. We do own McDonald's, but in our restaurants ETF, EATZ, we have it down at the very bottom, which is a great underweight, for the mega cap company that it is. Their CEO talked about weakness, talked about less people eating breakfast, consumer, but he didn't want to admit that fast casual and casual restaurants are taking away any market share. And I disagree with that strongly. When we see a company like Brinker, that's our fund's number one holding. That's, Chili's, of course, the ticker symbol EAT. We have that right up at the top of our portfolio. Now, it did take a little dip when they came out with earnings, but they came out with very strong earnings and strong guidance. That stock, has been such a performer in the last year or so. People were just selling off a little bit, even though they look strong continuously. And we're just not seeing anything very attractive in the fast food sector of restaurants in particular. There's just too many headwinds there.
Okay. It's interesting that you mentioned the headwinds there. And you make a good point about, especially, say, the Chili's part of Brinker. But at the same time, if there is a weakening consumer, can you afford to keep up a family dinner like that compared to the value proposition? I would love to talk more about McDonald's, but I want to make sure we touch on to Shake Shack. Shake Shack reported revenue $320.9 million. Adjusted EPS was 14 cents a share. Missed estimates. Shares have actually been a little bit higher today. What's your reaction to these results, James?
My reaction to that stock is, and the numbers, which they missed, are huge, right? We were expecting 17 cents. They came in at 10. Yep. I think the stock is not a buy. I'd be a seller. My concern there is the tremendous expansion they did over many years is now coming back to haunt them as their sort of margins are compressed. At the multiple of 40% 40 times earnings, that's not a company we want to go to. Again, we want to go back to those consistent earnings that can go through a slower economy, which we're facing. Look at a McDonald's versus Shake Shack, which did better in 2022 with an inflationary spiral. McDonald's was up 8% in a down market. So we want to go back to that consistent earnings.
So the old playbook, the COVID playbook, it may, maybe that will work this time around. Dan, your views on how Shake Shack performed in its most recent quarter?
Well, it's ugly out there, and it's just a miss across the board. It's another one of those stocks that we have in our restaurants fund, but it's near the bottom half of that fund, underweighted. With restaurants, in the past year or so, it's just really been a story of the have and have-nots. We hear headlines about companies going bankrupt and closing up shop. And right now, the sweet spot, in my opinion, are the value-oriented casual restaurants. And those are offering the consumer the best bang for the buck, if you will, when Chili's is advertising a 3 for $10.99 special, people see that as, cheaper than most fast food. So fast food suffering. In our fund, when we first launched it during COVID, we were all about wings and pizza. Then our fund was focused on some of those fast casual restaurants like Chipotle and Sweet Green and Cava. And now our top holdings are really in those things that I just mentioned: Brinker, Cheesecake Factory, Texas Roadhouse, even Darden, which has a big stake in Olive Garden, of course.
Right.
It's about investing in the right spots of restaurants right now.
Okay. So I want to yield the floor to James for a final quick thought, because we have less than 2 minutes left for our conversation. Where do you like, beyond McDonald's, if this is more than a weather story and real signs of consumer fatigue?
I think the consumer staples where McDonald's lives, investors really want to focus there. It's not an AI play like it was last year. Everything was AI. This year is going to be about consistent earnings. AI still works, but companies like McDonald's, Unilever overseas, Procter & Gamble, Costco, all those really high-quality staples with very little debt, high return on equities, and international exposure, you really want to go there.
Okay. All right. Great perspective. All right. Our thanks to both James Demmert and Dan Ahrens for a look at the restaurant sector and earnings from both McDonald's and Shake Shack.